For years, the U.S. restaurant industry followed a familiar formula: expand locations, grow foot traffic, add more menu items, and rely on steady consumer demand. That model worked when labor was plentiful, costs were predictable, and dining habits were stable. But over the last few years, that formula has broken down. Rising wages, volatile food prices, delivery platform fees, and shifting consumer behavior have forced restaurant chains into a full-scale reset. The question now is not which brands are growing the fastest, but which ones are adapting most effectively to this new reality. The Great Restaurant Reset is not about survival alone. It is about redesigning operations, menus, pricing strategies, and even physical locations to fit a very different market environment. Some major U.S. chains are clearly pulling ahead, while others are struggling to adjust. The winners are not always the flashiest brands. In many cases, they are the ones making disciplined, sometimes uncomfortable changes behind the scenes. One of the biggest shifts shaping the reset is cost structure. Labor costs remain elevated compared to pre-2020 levels, and restaurants can no longer assume they will ever return to previous norms. Winning chains are redesigning workflows to reduce labor intensity rather than simply absorbing higher wages. This includes simplifying food prep, reducing menu complexity, and investing in kitchen layouts that allow fewer employees to handle peak demand. Brands that depend on highly customized orders or labor-heavy preparation are finding this adjustment much harder. Menu simplification has become one of the clearest dividing lines between winners and laggards. Chains that aggressively trimmed menus are seeing faster service times, lower waste, and more consistent quality. Customers, it turns out, are less focused on having endless choices and more focused on reliability and speed. Brands like fast casual and quick service leaders that streamlined offerings are outperforming those that tried to maintain sprawling menus built for a different era. Pricing strategy is another major factor, separating winners from losers. Across the industry, menu prices have risen significantly, but the most successful chains are being strategic rather than reactive. Instead of uniform price hikes, they are using targeted pricing, smaller portion adjustments, and value bundles to protect traffic. The goal is not to be the cheapest option, but to avoid sticker shock that pushes customers to dine out less frequently. Chains that raise prices too aggressively without offering perceived value are seeing traffic declines even when revenues appear stable on paper. Digital operations are no longer a differentiator, they are a requirement. However, the reset is revealing that not all digital strategies are equally effective. Winning chains are focusing on owned digital channels like mobile apps and loyalty programs, rather than relying heavily on third-party delivery platforms. Delivery remains important, but the margins are thin. Brands that can shift customers toward direct ordering while still offering convenience are retaining more profitability per order. Loyalty programs, in particular, are becoming central to how chains stabilize demand and gather customer data. The physical footprint of restaurants is also changing. Many chains are rethinking dining room size, store layouts, and even whether traditional dining rooms are necessary at all. Smaller footprints with optimized kitchens are becoming more common, especially in suburban and high-rent urban areas. Some brands are experimenting with pickup-focused locations, while others are redesigning dining spaces to encourage faster turnover rather than long stays. The reset is about matching real estate costs to realistic customer behavior, not nostalgic expectations. Supply chain discipline is another quiet advantage for winning chains. Volatile food prices have exposed weaknesses in sourcing strategies. Chains with diversified suppliers, flexible menu inputs, and strong procurement teams are navigating inflation far better than those locked into rigid contracts or narrow ingredient lists. This flexibility allows them to adjust portions, substitute ingredients, and manage margins without constant price changes that frustrate customers. Brand positioning has also become more important during the reset. Consumers are more selective about where they spend money on dining out. Winning chains have clear value propositions, whether that is affordability, speed, consistency, or a specific dining experience. Brands that occupy a vague middle ground are struggling to justify their prices or attract loyal customers. The reset is rewarding clarity and punishing confusion. Another major factor is how chains are treating expansion. Before the reset, aggressive location growth was often seen as a sign of success. Today, winning chains are far more cautious. Many are slowing expansion, closing underperforming locations, and focusing on improving unit economics rather than adding new stores. Investors and operators alike are placing more value on profitability per location than total store count. This shift reflects a more mature, risk-aware approach to growth. Labor strategy goes beyond wages alone. Successful chains are investing in training, clearer career paths, and more predictable scheduling. High turnover is expensive, disruptive, and damaging to customer experience. Chains that treat labor stability as a competitive advantage are seeing better execution and lower long-term costs. The reset is forcing restaurants to compete not just for customers, but for reliable employees in a tight labor market. Marketing approaches are evolving as well. Big national campaigns are giving way to more localized and digital-first efforts. Winning chains are using data from loyalty programs and online ordering to tailor promotions and messaging. This allows them to drive traffic during slower periods without resorting to blanket discounts that hurt margins. Precision is replacing volume in restaurant marketing strategy. Importantly, the Great Restaurant Reset is exposing that scale alone is no longer enough. Some large, well-known chains are struggling precisely because their systems were optimized for a world that no longer exists. Meanwhile, other large chains are proving that size can be an advantage if paired with flexibility and disciplined decision-making. The difference lies in how quickly leadership teams accept that old playbooks are obsolete. Looking ahead, the winners of the reset are likely to continue separating themselves from the rest of the industry. They are building operations designed for uncertainty rather than stability. They assume costs will remain volatile, labor will stay competitive, and consumer behavior will keep evolving. Instead of chasing rapid growth, they are focusing on resilience, efficiency, and long-term brand trust. The Great Restaurant Reset is not a temporary phase. It represents a structural shift in how U.S. restaurant chains operate and compete. The chains that are winning are not necessarily the ones opening the most locations or launching the flashiest menu items. They are the ones making disciplined, often invisible changes that align their businesses with today's economic reality. In a tougher, more complex market, adaptability has become the most valuable ingredient of all.